Thank you very much indeed. White House National Economic Council Director Kevin Hassett joins me now. Kevin, welcome back. That was a strong jobs report. How does a strong labor market translate into lower interest rates?
Right. Well, first of all, I got to say that Ed did a great job summarizing the headlines. I would just add a couple more, and then I'll go into the interest rate story. The first is that there's been the story that everybody's been worried about that AI is going to make it so that nobody can get a job. Obviously, the top line job number says that's not true. But the more interesting thing to me is that labor force participation, the percentage of Americans that are looking for a job or have a job, it actually went to its highest level since 2001. So actually people are coming back off the sidelines into the labor market because they see the high wage growth, all the factory starts and so on. And so that's thing one. Thing two is that because we've been reducing government workers, federal government workers so much, about 360,000 this year, that the jobs numbers actually kind of understate how wonderful the economy is doing because the government worker employment has been a drag. And to put it in perspective, that we've got the lowest government worker number since 1966 and the lowest share of government workers in the labor force in all of history. And so we have done something really, really dramatic in downsizing government. And what that does is it helps us be fiscally responsible and get interest rates lower. Now, the bottom line is that I've been saying on your show really since we started over a year ago, Stu, that I think that we're going to have a big positive supply shock and that we could have high growth and low inflation. Right now, we've got high growth and low inflation, and I think there's plenty of room for the Fed to cut rates because this theory about why you would lift rates right now because of high growth is an old-fashioned Phillips curve story that doesn't really apply when you get a big positive supply shock from AI or the internet. Alan Greenspan understood that back in the 90s, and let's hope that some people at the Fed understand it now.
So do you believe that the next move by the Federal Reserve will be down and that move will come fairly soon?
I believe that what's going to happen is that when we look at the inflation numbers, that it's going to be inconsistent with what the Fed's been thinking about. It's going to happen because of the Phillips curve, and it's going to make them scratch their heads and wonder what they're doing with the highest interest rate on earth.
Okay, we shall see. Next one. President Trump says the economy is about to boom. Watch this.
We should grow 15 or 20%. We should be at 15%. I'll tell you, if our new head of the Fed, who I think is going to be great, and he's a really high-quality person. He was and your friend Kevin was great, but I want to keep him with us, too. I said to King, look, I had the two Kevins, right? But I wanted to keep him with us. He's doing great. But if he does the job that he's capable, we can grow at 15%. I think more than that.
The president is saying, yeah, we can get 15% if Kevin Warsh lowers interest rates at the Fed. That's going to take some time, isn't it?
You know, that's aspirational 15%, but I can tell you that you can get a really high number if you figure that productivity is growing maybe 3.5%, that capital spending is adding like capital stock growth of maybe 1.5%, and whatever we get out of labor is going to be, say another percent. So you could really easily see a 4 to 5% year this year just because of the AI boom and how it's affecting the productivity of firms all around the country. If 15 were to happen, I mean, there are some countries like Ireland that have 15, so the president's not wrong to hope that we have the best number in the world. He's a very aspirational guy who tends to get things right, but I'm happy to say that I'm comfortable thinking that we could have a 4 or 5 year.
Okay, we shall see. Kevin Hassett, it was a pleasure. Thanks very much for